In this video, we are going to be analyzing ticker LUNR because it is running after hours up over 30% from around a 550 close all the way up to $7.75. Now, why has it done this news? This is of a fundamental reason. They have secured a NASA contract. So there is a fundamental reason for this stock to go up, and as of right now, I wouldn't even say it's kind of extremely like an overreaction or anything. So to be honest, it could continue to run, and that's where I think the plays will provide themselves. Looking at this, it is hard to borrow, but it does provide options. So options would be the way I'll be looking to trade this stock, either outright options, or if we can get shares available to short, I'll be looking to short these shares. But the key thing is not shorting them right now. Reason for that is, again, we are at 775. We're at these blue lines. What are these blue lines? These are our second deviations. So dashed lines a 6-month level, these solid lines a 1-year level. So this is considered overbought, but definitely can run. And again, we've got that catalyst. We've got a fundamental reason for this stock to be running. So seeing this push through both of these levels and continue to run isn't unlikely. So getting in short now would not be a great idea. Now, what we can see in the past on the old contract news, it did a run, came into that second deviation and sunk. But what was the key thing was where we opened, we came into kind of these this red one and this green one. Now, what are these? Again, we can kind of go on this chart to kind of get a bit more of a clearer vision of this. So the red line is a 4th deviation, the green line is a 3rd deviation. Now, if you understand standard deviation and how standard deviation works, what you'll understand is that 99.7% of data should trade below that green line. Now, it is a stock market, nothing's going to be 99.7% accurate, but it does give us a good signal that price will likely decrease when we start pushing up to that price. So that would be my main play on this, waiting for this stock to push high. If it doesn't run and it just crumbles before, cool, we'll miss a trade opportunity, we won't trade it. However, if we can start pushing into kind of this 890 area or above, and again, that's going to be 890, 925, 1020 and 1060. These are going to be the key short bias areas, and especially kind of these upper two, because I do think we'll kind of run and kind of come into that $10 resistance paired with the standard deviation, the 4th standard deviations. And again, we needed a contract to go from what I would still call quite a reasonable reaction into an overreaction, which would be these levels here. So again, once we start coming into these levels, the way I would trade this is either outright puts or short the shares, buy the calls to define the risk. Now, again, it's all down to will you be able to get shares available to short. Depending on your platform, you might be able to locate some and get short. And if you can, again, we have different expirations. Probably a month will be a safe one, either the 24s or the 31, just depends on liquidity and prices. But again, if you can kind of go out, obviously these strikes will change on the open because the move has happened after hours. But again, if we can get, say, a $10 strike call for $100 and we're able to short the shares, it would make sense because, again, we're looking to short it around $9 to $10. You're looking to take $100 to $200 risk, and you expect this stock to fall back down to, say, a $7 target roughly, or a $7.50 target. So the risk to reward would make sense. Or again, we can go for the outright puts. Even if we went back here, the $10 puts were about 630. Obviously, these will change in price, but the at-the-money ones were about 205. These will have new premium implied volatility increase tomorrow. So the at-the-money options going out 31 days will probably be closer to $250 to $300. But again, overall, if you can kind of get short around that $10, if the move can happen quickly, obviously you're paying $300 in premium, but if the move can happen quickly, then again, we'll still target kind of down here. As a kind of a first target would be down to this level. So overall, short bias coming into 890 and above. Again, if we can get short shares available to short, that will be the cheaper way to trade this. You need more capital up front, but it will be cheaper and less reliant on premium changes, which will provide the easier short opportunity. If we can't get shares available to short, probably still going to be a nice setup. I would be more patient and wait for kind of the upper 4th deviation and look to short down to a target of the 2nd deviation. And kind of what the way levels, you can use these levels as well, is you change to a 5-minute candle or 5-minute candles. You see what is the range created on the initial news announcements, which is here, and you just fib out these levels. Expect price to come and at least kind of come and retest the top, so that would be a 743 target. And again, it's not unlikely for fibs to start testing these upper levels. So 857, 1040, 1040 I think would be that nice one, the 261 fib, and you got the 2/4 standard deviation levels. And if we did get a kind of more of a breakout, you could even target kind of 1340, but I don't think that's as likely. The nicest short will probably be around $10. And again, whether that's outright puts or shorting the shares and buying calls to define that risk.